it's a perfect time to invite our next guest on the show, Gautam Baid, Equity Advisor at Complete Circle Stellar Wealth PMS on the show. Gautam, morning, and thank you very much for joining in. I know in your coverage you have a lot of NBFCs that you look at. Now, last week, the RBI, in a way, has tightened the screws on this unsecured retail lending, which is taking place because they believe the growth rate is too high. There is a risk of rising delinquencies. Can you talk about the impact and how is it affecting the companies under your coverage? And would you therefore perhaps look to trim some profits in it or book out?
Well, Reema, the true test of a lender is actually found out during a rising interest rate cycle. And in our PMS, we do hold stock of Poonawalla Fincorp. And 70% of their book is in unsecured retail, and that would be affected by the increased risk weights as mandated by the RBI. However, less than 5% of Poonawalla's book is now of a ticket size of 50,000 rupees or less. So they have now tried to get into higher size ticket loans. So that's a positive. Plus, even though 70% of the current loan book is unsecured in nature, if you look at the latest quarter loan book profile of Poonawalla Fincorp, 83% of the disbursements were in secured lending, whereas only 17% was in unsecured lending. So they're taking all the right steps to de-risk their loan book. And because of this, the management has guided for a compression in net interest margins from 12.4% in the latest quarter to 10% in the medium term. But over the long run, if this is a sustainable level of NIMs which the management is targeting, then over many years, I think the shareholders would do pretty well. And also, in a rising interest rate environment, what is very commendable about this company is that they actually managed to increase their net interest margin by a few basis points in the latest quarter. And that is because they were able to manage their cost of funds very well. So if you are able to manage your liability side of the balance sheet well as an NBFC, then that's a large part of the work done. Now they just need to focus on maintaining the asset quality.
But do you expect the growth rates for Poonawalla Fincorp to come down as they focus more on secured lending rather than unsecured lending? Because I'm seeing the Q2 numbers and the growth rates are very high. Disbursements, for instance, was 11% up on a quarter-on-quarter basis, 150% up on a year-on-year basis. The AUMs have gone up by 54% on a year-on-year basis. Is it time to prune the growth rates for these companies, even as we watch how the asset quality, unfolds?
That would be the prudent thing to do because it's very easy to aim for hyper growth in a lending business. After all, you're giving money away, but the true test is getting all the money back. So if they do trim down the guidance, there has been no formal announcement by the company on this front, but if they do trim down the growth by 5-10% from the current scorching pace of growth, actually that would be a good thing for the shareholders.
Okay, that's Poonawalla Fincorp. Gautam, hi. Good to be speaking with you. Hope you had a fantastic Diwali and festive season. I want to expand that question to banks as well because NBFC is one part of the story. The other is banks. And a lot of banks were going so strong on this unsecured portfolio, right? It was great yields. It was working well. It was a happy situation on margins. Now, I think that's where the debate is going on. Whether growth will continue, you just price the loans a little more steeply and people will still coming in, or whether banks themselves will have a mindset change, realizing the signaling that's coming in from the Reserve Bank of India. What do you think, first of all? And, how are you positioned on otherwise overall banks, tier 1 large cap blue chip banks, as well as tier 2 banks, if you look at them or if you like them?
Well, hi Surabhi. In our PMS, we do hold ICICI Bank as just a standard disclosure. I have investment in this stock through my India fund, and our clients have exposure in it through our PMS. And we also hold stocks of small finance banks. The key thing which we're tracking, like you rightly said, because of this increase in risk rates, now the banks will definitely slow down on this hyper growth segment. But in the short run, the growth rates may taper down slightly, but at an aggregate level. But over the long run, the markets tend to reward lenders, which are basically de-risking their loan book. And I'm very happy to say that we have got one of the best central banks in the world in the form of the RBI, which does not allow large bubbles to form in any segment of the lending industry. In this case, the unsecured retail lending, because that was simply getting out of hand. We had inkling that this move would come, and it has come. I think the next big sledgehammer will probably fall on FNO, futures and options, and there are certain listed stocks which are whose earnings are very sensitive to earnings from options trading. In fact, if you do a simple, Google Trends search on options trading versus multi-baggers, actually options trading term eats the term multi-bagger for lunch. If you look at the last 5 years, it has really taken off in a very big way in India. So I think that is where the next big sledgehammer will come, probably from SEBI this time around.
Everyone's waiting. Let's see how that one plays out. But, just to complete the point on banks, you mentioned that you are owners on ICICI Bank. So you're staying put. Is that right, that you would not be perturbed if growth comes off a few basis points from this high-yielding portfolio? I mean, would you change anything in terms of the small finance lenders or a giant like ICICI that you hold?
Well, we would not be adding incrementally to our positions in these names, but we would stay put with our existing allocation. I think that is the right way to approach it right now. And we would keep a razor-eye focus on the asset quality, because at the end of the day, that is the single most important metric we have to focus on as investors and in any lending business.
The other stock in your PMS is Prudent Corporate Advisory, which is basically a distribution platform for mutual funds, stock broking, gold accumulation plans, etc. Do you want to tell us why you like this stock?
Well, Reema, at Complete Circle Stellar Wealth PMS, we are very, very bullish on the financialization of savings theme for the next 1 decade. And just to give you some rough numbers here, 4 years ago, the monthly SIP book in India was less than 8,000 crores. And in the most recent month of October, we have almost touched 17,000 crores. So that gives you an indication about the growth rate trend of this particular theme. In addition to that, you also benefit from the mark-to-market, stock market gains over the long run. So, if the SIP flows continue to increase at a double-digit rate of 10 to 12%, and you add to that the market return of 10 to 12% over the long run, then you get a blended aggregate growth potential for Prudent Corporate at around 20 to 24%. And also, the biggest competitive strength of Prudent Corporate is its large mutual fund distributor team on the ground. So they have a network of more than 27,000 mutual fund distributors. And once you have such a large pan-India distribution network set up in place, the advantage is, just like in FMCG business, you can start cross-selling other financial products to your clients. So just recently, they have started cross-selling insurance products to their clients. And they're also offering new financial products as well. So there is no incremental cost as such of this additional incremental revenue stream. So that's a big competitive advantage that Prudent Corporate has. One big antithesis point for this particular business is, what if they are unable to pass on the cut in total expense ratio by SEBI? But we should always look at history to get an idea about what the future may look like. So in April 2019, when SEBI had last cut the total expense ratio, the gross margin of Prudent Corp actually expanded from 36% to 38% over the next 12 months, because they were able to pass on this reduction in TER to their distributors. So that gives you an indication of pricing power. And once you have identified a mid-cap or a small-cap company with pricing power and sectoral leadership in its industry, I think you have got a compounding machine in the making. And that is what our belief is in this particular business for our PMS clients.
Okay, Gautam, got that. Thank you very much. Good talking to you as always. Look forward to more conversations. You have a great day, and we will keep connecting.